Okay, be honest. You've been seeing the headlines. Stock market at all-time highs, valuations stretched, warning signs flashing, and you're sitting there with your 401k thinking, should I just sell everything? Move to cash? Wait for the crash everyone's predicting? Or maybe you're on the opposite side. You've got $15,000 saved up, you've been wanting to start investing for years, but now you're thinking, what if I invest right before everything crashes? What if I lose half my money? Here's the thing that drives me absolutely crazy. Every single year, someone is predicting a market crash, and every single year, millions of people make catastrophically bad financial decisions because they're trying to time the market based on predictions that are basically just astrology for finance people. But 2026 is different, right? The valuations really are high. The economic indicators really are looking weird. Except I'm going to show you why that thinking is exactly what keeps people from building wealth, and why the actual data tells a very different story than what the doom and gloom headlines want you to believe. My name is Brenda, and I spend way too much time thinking about whether 2026 is actually setting up for a market crash and what you should actually do about it. If you're someone who's paralyzed by market uncertainty, or you sold your investments in a panic and now you don't know when to get back in, or you've been sitting on cash for months waiting for the right time to invest, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what I'm about to show you isn't market timing advice. It's about understanding what actually predicts market crashes, what the historical data tells us about trying to avoid them, and most importantly, what you should actually do with your money right now, regardless of what happens in 2026. Let me start with something that's going to annoy you. There is an entire industry built around predicting market crashes, and that industry makes money whether their predictions are right or wrong. Think about the incentive structure here. If you're a financial pundit and you predict a crash every year, eventually you'll be right. And when you're right, you get to say, I predicted the crash, and you become famous and sell a bunch of books. But if you're wrong 9 times, nobody remembers. People don't write headlines about economists wrong again for 9th consecutive year. According to research tracking market predictions over the past 30 years, professional forecasters have predicted 15 of the last 3 recessions. Read that again, 15 predictions, 3 actual recessions. They're wrong more than 75% of the time. And here's the kicker. Even when they're right about a crash eventually happening, they're almost always wrong about the timing. Someone who predicted a crash in 2017 and moved to cash, they missed 80% gains before COVID hit in 2020. Yeah, they avoided the COVID crash, but they also missed the recovery and are still behind where they would have been if they'd just stayed invested. Now, let's talk about the main thing people are worried about right now, valuations. The S&P 500's price-to-earnings ratio is sitting around 24 as of early 2026. The historical average is 16, so stocks are expensive by historical standards. That's just a fact. And expensive stocks can mean lower future returns, also true. But here's what most people miss. High valuations are not a market crash predictor. Let me show you the actual data. According to research from Vanguard analyzing market data from 1926 to present, there is basically zero correlation between current valuation levels and market performance over the next 12 months. Zero. High valuations do predict lower returns over 10-15 years. If you buy when P/E ratios are high, your annualized returns over the next decade will probably be lower than average, maybe 7% instead of 10%. But that's not a crash. That's just lower returns. Those are very different things. Want to know what actually predicts crashes? It's usually a combination of excessive leverage in the financial system, credit bubbles about to pop, sudden external shocks like a pandemic, war, or oil crisis, Fed hiking rates aggressively into a weakening economy. Notice what's not on that list? High valuations. The dot-com bubble in 2000 crashed because companies with zero revenue had billion-dollar valuations, and the whole thing was built on leverage and delusion. The 2008 financial crisis crashed because the entire banking system was over-leveraged on toxic mortgage debt. The COVID crash, a literal pandemic shutting down the global economy. None of these were simply valuations were high, therefore crash. Okay, but let's say you're still worried. Let's say you're thinking, better safe than sorry. I'll just go to cash and wait for the crash. Let me show you what this decision actually costs. Let's say you have $50,000 invested. You sell everything today and move to cash, waiting for a 30% crash to buy back in. Scenario 1. The crash happens this year. You avoid the 30% drawdown, saving $15,000. You buy back in at the bottom. Congratulations, you timed it perfectly. Scenario 2. The crash doesn't happen this year. The market goes up 12%. You missed $6,000 in gains. You're still waiting. Scenario 3. The market goes up 12%, then crashes 30%. So it's at 78.4% of the original value. 1.12 times 0.70 equals 0.784. You avoided the crash, except the market is now only 21.6% below where it was when you sold. Your $50,000 in cash can now buy what was originally $62,656 worth of the market, so you're buying at $49,140 of market value. You actually lost money trying to avoid the crash. But here's the real killer. Let's say the crash never comes. The market goes up 10% per year for 5 years. Your $50,000 in cash is still $50,000. The person who stayed invested has $80,526. That's $30,526 you lost, and I haven't even accounted for inflation eating away at your cash. According to Fidelity Research, analyzing investor behavior from 1980 to 2020, investors who tried to time the market underperformed buy-and-hold investors by an average of 3.2% per year. On $50,000 over 20 years, that's a difference of $60,000 in lost wealth. Here's what most people don't realize about why market timing fails. It's not just that you have to be right about when to get out, you also have to be right about when to get back in. And that second part is way harder because of loss aversion. Let me tell you about someone I know. We'll call him Tom. Tom sold all his investments in March 2020 when the market crashed 35%. He was terrified it would go lower. He'd wait for the dust to settle. By June 2020, the market had recovered most of its losses, but Tom was still paralyzed. It's too risky, this recovery isn't real, the economy is still terrible. By January 2021, the market was 15% above pre-COVID levels. Tom was now completely stuck. If he bought back in, he'd be buying higher than where he sold. His ego couldn't handle it. By the time Tom actually got back into the market in late 2021, he'd missed 60% plus in gains. He lost nearly 2 years of retirement savings by trying to avoid a crash that recovered in 6 months. This is the psychological trap. Getting out feels smart. Getting back in feels like admitting you were wrong, so people stay in cash forever. Okay, let me show you what the historical data actually tells us about market crashes and what to do about them. Since 1950, the S&P 500 has had 10 corrections of 20% or more, what most people would call a crash. That's roughly 1 every 7.5 years. Average time from peak to trough, 13 months. Average time to recover to previous peak, 22 months. Average total time below water, 35 months. So yeah, crashes happen, and they suck. But here's the thing, if you stayed invested through all of them, your money still compounded at roughly 10% per year, including the crashes. $10,000 invested in 1950 turned into $20 million by 2025, crashes included. But if you missed just the 10 best days in the market over that 75-year period, your $10 million becomes $9 million. Miss the best 30 days, and it becomes $3 million. And here's the really important part. The best days tend to happen right after the worst days. They cluster during high volatility periods. If you're out of the market trying to avoid the bad days, you also miss the best days. According to JP Morgan research, 7 of the 10 best market days in the past 20 years occurred within 2 weeks of the 10 worst days. So if market timing doesn't work, what do you actually do? The strategy that has historically worked is stupidly simple, and I hate that it's this boring, but keep investing consistently regardless of what the market is doing. Let me show you the math on why this works. Let's say you invest $500 per month starting in January 2025. Scenario 1. The market goes up 10% every single month for a year. Unrealistic, but stay with me. You invest $6,000 total. Your ending balance is about $6,350. Scenario 2. The market crashes 30% over 6 months, then recovers over the next 6 months back to where it started. You still invest $500 per month. You invest the same $6,000 total. Your ending balance is about $6,420. Wait, what? You made more money in the crash scenario? Yes, because during the 6 months the market was down, you were buying shares at a discount. This is called dollar cost averaging, and it's the antidote to market timing. When prices are high, your $500 buys fewer shares. When prices are low, your $500 buys more shares. Over time, you automatically buy more shares at lower prices without having to predict anything. I know someone, let's call her Maria, who started investing $300 per month in January 2020, the absolute worst possible time, right before COVID. By December 2020, she'd invested $3,600 and had about $4,200. She made money in the year of the crash by just keeping at it. All right. Here's your actual action plan regardless of whether 2026 crashes or not. Step 1. If you're not investing yet, start now. Not after the crash, not when things stabilize, now. Even if it's just $50 per month. The best time to start was 10 years ago. The second best time is today. Step 2. If you are investing, keep your contributions consistent. Don't increase them because you think the market's about to boom. Don't decrease them because you're scared. Consistency is the entire strategy. Step 3. If you're sitting on a pile of cash waiting to invest, stop trying to time it. Use a systematic approach. Invest a fixed amount monthly over 6 to 12 months. This reduces the risk of putting everything in right before a crash while also getting your money working sooner than waiting forever for the perfect entry point. Step 4. If you sold in a panic, I need you to be honest about whether you're actually going to buy back in. If you're not, you need to admit you're just afraid and develop a strategy to overcome that fear. If you are going to buy back in, do it systematically over the next few months. Step 5. Stop consuming crash prediction content. Seriously, unfollow the doom accounts. Stop clicking the market crash imminent headlines. This content is designed to generate anxiety, which generates clicks, which generates revenue for them. It's not designed to help you build wealth. Now I know what you're thinking. Brenda, you're basically telling me to ignore risk. That's insane. No, I'm telling you that attempting to time the market is a different kind of risk that most people completely ignore. The risk of being wrong and missing years of gains while you sit in cash. Let me put it this way. What's riskier, staying invested through a potential 30% crash that historically recovers within a couple of years, or sitting in cash for potentially years waiting for a crash that might not come, missing compounding returns the entire time? Because the data is very clear. The second option has cost more people more money than the first option. Here's the math. If you stay invested through a 30% crash and subsequent recovery, your average annual return over a 10-year period is still around 9 to 10%. If you go to cash trying to avoid the crash but miss the timing, your returns are basically 0% in cash minus inflation, which is negative 2 to 3% real returns. One of these strategies has made millions of people wealthy over time. The other has made exactly zero people wealthy. Look, I'm not going to sit here and tell you the market won't crash in 2026. It might. It might crash in 2027 or 2028, or it might not crash for another decade. Nobody knows. Not me, not the financial pundits, not the Nobel Prize winning economists. Nobody. But here's what I do know from 100 years of market history. Crashes are temporary. Long-term growth is permanent. And the people who stayed invested outperform the people who tried to be clever 100% of the time. The math is brutally clear. Market timing doesn't work for retail investors. It barely works for professionals with entire research teams. You're not going to crack the code by reading headlines and feeling anxious. What does work? Investing consistently, staying invested through volatility, and letting compound growth do its thing over decades. That's it. That's the entire secret. So here's your challenge. For the next 12 months, commit to investing a consistent amount every single month, regardless of what the market does. Don't check the news. Don't try to predict crashes. Just invest and live your life. I'm betting that a year from now, you'll be wealthier than if you'd spent that year trying to perfectly time your entry point. If this video helped you realize that sitting around worrying about crashes is costing you money, smash that like button and subscribe, because we're going to keep cutting through the fear-mongering noise and focus on what actually builds wealth. Now go set up that automatic investment and stop trying to outsmart the market. Your future self will thank you.